Assalamualaikum and a very good day. Today, we will present about comparative financial analysis of two major plantation companies in Malaysia, which is Kuala Lumpur Kepong Berhad, KLK, and SD Guthrie Berhad, SDG. First, for the industry overview. The plantation sector is one of the Malaysia's most important industry and contributes significantly to the national economy. Malaysia is also among the world leading producers and exporters of palm oils, making industry a major source of export earnings and employment. Palm oils continue to enjoy strong global demand because it is widely used in the food products, cosmetic, oleochemicals, and biofuel productions. As a result, the performance of plantation companies has a substantial impact of the country's economic growth. For this study, we selected Kuala Lumpur Kepong Berhad and SD Guthrie Berhad because these both companies are listed on the Bursa Malaysia main market and they are among the largest and the most established players in the plantation industry in Malaysia. First, let us look at the background of Kuala Lumpur Kepong Berhad or KLK. KLK was established in 1906 as a plantation company and has grown into one of the leading plantation groups in Malaysia. Its core business focuses on oil palm and rubber plantation. Currently, KLK owns approximately 300,000 hectares of planted area, with about 98% dedicated to oil palm cultivation. The company operates plantation across Malaysia, Indonesia, and Liberia, giving it a strong international presence. Besides plantation activities, KLK has diversified into research-based manufacturing, including palm oil refining and oleochemical production. This diversification allows the company to create additional value from its plantation outputs. KLK is also vertically integrated, meaning that it is involved in upstream, midstream, and downstream activities throughout the palm oil supply chain. This helps to improve operational efficiency and strengthens the competitive position in the market. In addition, the company has expanded into property development through KLK Land and has further diversified into industrial development with the launch of KLK Tech Park in 2025. Overall, KLK diversified business models helps to reduce its dependence on plantation income and provides multiple sources of revenue for long-term growth. Next, let us look at the background of SD Guthrie Berhad. SD Guthrie Berhad was formerly known as Samdabi Plantation Berhad and it was officially renamed in 2023. The company is a subsidiary of Samdabi Berhad and is linked to the Pemodalan Nasional Berhad, which is one of the Malaysia's largest investment institution. SD Guthrie is recognized as world's largest listed palm oil company in the terms of planted area. The company is also one of the leading producers of certified sustainable palm oil or CSPO, demonstrating its strong commitment and sustainable plantation practices. The company operates a fully integrated business model with a traceable and deforestation-free supply chain. Its upstream operation cover the entire production process from developing seedlings and cultivating oil palm plantation to producing crude palm oil or CPO. In addition, SD Guthrie has a strong downstream business segment that produce various palm-based on products, including palm oleins, palm stearins, and oleochemicals. These products are supplied to global industries such as food manufacturing, consumer goods, and biodiesel production. Among all its business segments, the downstream division contributes the largest share of the company's revenue, highlighting its importance in driving SD Guthrie overall financial performance. Overall, SD Guthrie is a large-scale operation, integrated supply chain, and strong focus on sustainability position the company as a global leader in the palm oil industry.
The income statement table shows the company's financial performance from 2021 to 2024. Revenue increased significantly in 2022, reaching RM27.15 million, before declining slightly in the following years. Net income showed a downward trend from RM2.45 million in 2021 to RM738,000 in 2024. Average profit remains stable. The average daily operating cost increased each year, which may have contributed to decline in net income. The balance sheet table presents the company financial position from 2020 to 2024. Total asset increased from RM20.95 million to RM30.53 million, showing overall growth. Shareholder equity also improved over the period, although it declined slightly in 2024. Current assets remain stable at around RM9 to RM10 million, while cash and cash equivalent decreased after 2021. Overall, the company maintained a relatively strong financial position despite some fluctuation. The income statement table shows the company financial performance from 2021 to 2024. Revenue peaked at RM21.03 million in 2022 before fluctuating in the following years. Net income remained relatively stable, ending at RM2.34 million in 2024. Gross profit declined significantly in 2023 but recovered in 2024. Meanwhile, average daily operating costs increased sharply after 2021, indicating higher operating expense over time. The balance sheet table shows the company's financial position from 2020 to 2024. Total assets increased steadily from 28.3 million to 22 million, while shareholder equity grew from 16.3 million to 21.2 million. Current assets remain stable, and current liabilities dropped significantly in 2024, indicating stronger liquidity and overall financial health.
Now let's look at the DuPont analysis for KLK Berhad from 2021 to 2024. The net profit margin declined consistently over the 4 years, indicating that the company became less efficient in turning sales into profit. This suggests a decrease in profitability and a reduction in earnings generated from each ringgit of sales. Next, asset turnover of KLK Berhad increased from 0.8125 in 2021 to 0.9311 in 2022, showing improved efficiency in using assets to generate sales. However, there are decline of ratio to 0.7344, indicating that asset utilization became less efficient in the later years. Equity multiplier for KLK Berhad remained stable, maintaining between 1.87 and 1.95 throughout the period. This suggests that the company's use of debt financing did not change much and that its financing strategy remained consistent.
From the data above, the net profit margin dropped slowly in 2021 to 2023. This indicates that the company became less effective at converting sales into profit. Over a measured period in 2024, it increased slightly. Asset turnover increased from 0.6374 in 2021 to 0.6840 in 2022, showing improved efficiency in using assets to generate sales. However, there was a drop in the ratio to 0.5847, indicating that asset utilization became less efficient in the later years. For equity multiplier, remained downward from 1.7188 to 1.5381 throughout the period. This suggests that the company's use of debt financing did not change much and that its financing strategy remained inconsistent.
I will now present the ROE comparison between KLK Berhad and SD Guthrie Berhad based on the DuPont analysis. This slide shows the ROE performance of both companies over 4 years. KLK Berhad started with a strong ROE of 80.85% in 2021 and experienced a gradual, steady decline over the years. dropping down to 4.13% in 2024. Although it started high, its ability to generate shareholder return decreased consistently over the examined period. On the other hand, SD Guthrie Berhad maintained a highly stable performance in 2021 and 2022, with an ROE holding steady at around 40.5%, while the company faced a moderate cyclical dip to 10.31% in 2023. It demonstrated immense structural strength by staging a robust recovery to 11.28% in 2024. Overall, SD Guthrie crossed over that maintained significantly better shareholder return by the end of the period, demonstrating far greater financial resilience compared to KLK. To understand why SD Guthrie performed better, we break ROE into three components using the DuPont model. First, net profit margin. SD Guthrie recorded an outstanding 11.82% compared to KLK 3.31%, meaning SD Guthrie generates significantly more profit every ringgit of sale. Second, asset turnover. KLK achieved 0.73 times while SD Guthrie recorded 0.62 times. This indicates that KLK used its assets slightly more efficiently to generate revenue, but SD Guthrie maintained a highly competitive operational velocity. Third, equity multiplier. KLK has 1.95 times higher than SD Guthrie 1.54 times, showing that KLK relies more heavily on financial leverage, while SD Guthrie maintained a more conservative and safer capital structure. As a result, SD Guthrie ROE reached a strong 11.28% compared to only 4.73% for KLK. When combining all three DuPont components, SD Guthrie performed vastly better in core profitability, which easily offset its more conservative leverage. This strength allowed SD Guthrie to achieve an ROE that is more than 2 times higher than KLK. Therefore, SD Guthrie created greater value for its shareholder and demonstrates stronger financial performance. There are three main reasons why SD Guthrie has superior financial strength. First, it has vastly stronger profit margin, providing better protection against rising costs and market uncertainty. Second, it utilizes its assets at a highly stable and competitive rate to generate income. Third, its strong profitability delivers superior shareholder return while maintaining a conservative use of leverage, while reduce financial risk. Together, these factors make SD Guthrie financially more resilient and structurally more efficient than KLK Berhad. In conclusion, the DuPont analysis showed that SD Guthrie Berhad outperformed KLK Berhad across the final key financial drivers. Although both companies faced cyclical shift over the years, SD Guthrie maintained excellent core profitability, stable asset utilization, and a much safer leverage management system by the end of the period. Therefore, SD Guthrie demonstrates stronger financial performance and create greater value for its shareholder compared to KLK Berhad.
This chart shows that current ratio trends for both companies. Current ratio measures whether a company can cover its short-term liability using current assets. For KLK Berhad, the ratio started at 2.0405 in 2022, then decreased to 1.8476 in 2023, and further dropped to 1.3304 in 2024. This downward movement suggests that KLK's liquidity position weakens over the time, possibly because current liability increased faster than current assets. Meanwhile, SDG showed a positive trend, increasing from 1.2492 in 2022 to 1.4471 in 2024. Although KLK still remained above the benchmark of 1.0, SDG demonstrated a more stable improvement in management short-term financial obligation. Next, the quick ratio excludes inventory and focuses only on more liquid assets. KLK's quick ratio slightly improved from 1.2588 to 1.2714, but then dropped significantly to 1.8715 in 2024. Since the ratio fell below 1, this indicates KLK may become increasingly dependent on inventory sales to pay short-term obligations. On the other hand, SDG improved gradually from 1.7224 to 1.8041, showing better management of liquid assets. Looking at the cash ratio, both companies maintain relatively low values. KLK cash ratio declined from 0.5410 to 0.3399, while SDG fluctuated around 0.12 to 0.17. This indicates that both companies rely more on operating cash flow and credit facility rather than holding large cash reserve, which is common within the plantation industry. Now is the net working capital to total asset ratio. This ratio reflects the amount of liquid resources available relatively to total assets and indicates the company's financial flexibility. KLK experienced a continuous decline from 0.1771 in 2022 to only 0.0759 in 2034. This suggests that KLK's financial cushions became smaller over time and indicates a reduction in illiquidity restraint. In contrast, SDG remained relatively stable and gradually improved from 0.0422 to 0.0617. This showed that SDG was able to slightly strengthen its financial flexibility during the period. Finally, interval measure ratio. The interval measure estimates how many days a company can continue operating using only liquid assets without receiving any additional revenue. KLK improved slightly from 76 days in 2022 to 85 days in 2034. However, SDG consistently maintained a much higher range of approximately 131 to 135 days. This means SDG can sustain its operation for a much longer period compared to KLK. Overall, based on the core liquidity indicator, SDG demonstrates stronger and more stable liquidity performance from 2022 to 2034, while KLK experienced declining liquidity condition despite remaining above minimum acceptable level.
First is the gross profit margin. Based on the graph, KLK Berhad recorded higher margins than SD Berhad during the period. KLK decreased from 18.32% in 2022 to 12.15% in 2023, before recovering to 18.73% in 2024. Similarly, SD fell to 8.73% and rebounded to 12.48%. Overall, KLK shows stronger gross profitability, although the gap narrows significantly in 2024. Next is the net profit margin. The graph shows that SD consistently outperformed KLK Berhad. SD remained relatively stable at around 11% to 13%, while KLK Berhad declined sharply from 8.98% in 2022 to only 3.31% in 2024. This indicates that SD Berhad was more efficient in controlling expense and generating net profit. For return on asset, both companies started at similar levels in 2022. However, as shown in the graph, KLK return on asset continuously declined from 8.06% to 2.42%, whereas ST recovered 7.31% in 2024. Therefore, ST utilized its asset more efficiently to generate profit. Lastly, the return on equity graph shows that KLK Berhad started higher at 15.19% in 2022, but experienced a sharp decline to 4.92% in 2024. In contrast, ST maintained a stronger and more stable trend, increasing to 11.07% in 2024. Therefore, ST provide better returns to shareholders over the period. In conclusion, KLK Berhad only performed better in gross profit margin. However, ST Berhad outperformed KLK Berhad in net profit margin, return on asset and return on equity, indicating stronger overall profitability and efficiency from 2022 to 2024.
Based on our financial analysis, KLK Berhad is currently facing some of financial challenges. The company's profitability has declined significantly, with net profit margin decreasing from 12.31% in 2021 to 3.31% in 2024. Return of equity also fell from more than 15% to below 5%. Although KLK's high leverage increases financial risk. However, the company's diversified business operation and global presence provide opportunities for future recovery. On the other hand, SDG Berhad demonstrate a stronger financial position compared to KLK. The company has maintained healthy profit margin, improved its liquidity position, and successfully reduced its financial leverage. Although its ROE declined substantially over the period, SDG positioned as one of the world leading palm oil producers. Together with its sustainability initiative and downstream expansion, also support a positive long-term outlook. Now, for the last part, which is a recommendation. For KLK Berhad, we recommend focusing on margin recovery through cost optimization, particularly in its plantation and oleochemical divisions. The company should increase investment in mechanization and digital farming technologies to improve efficiency and reduce labor costs. KLK should also carefully manage its debt levels to minimize financial risk when continuing to explore growth opportunities through its diversified business portfolio and global market presence. For SDG Berhad, the company should prioritize improving its return on equity by increasing profitability and using shareholders' funds more efficiently. Expanding downstream refining capacity, especially in growing markets such as India and China, could help improve profit margins. In addition, investments in renewable energy projects such as biogas and solar energy can create additional revenue streams. Finally, SDG Berhad should continue strengthening its sustainability initiative to support long-term growth and enhance their shareholders' value. In conclusion, SDG currently demonstrates a strong financial position compared to KLK. However, both companies have a strong fundamentals and significant growth potentials. By implementing the recommended strategies, both companies can improve their profitability, strengthen their financial performance, and create sustainable value for shareholders in the future. Thank you.